Hello, my name is Stephanie Robinson, and I'm a director in the International Corporate Services Group in KPMG's Washington National Tax Office. The recent legislation to address the tax side of the fiscal cliff provided for the retroactive extension of numerous expiring tax provisions, including the CFC look-through rule in Section 954C6 and the active financing and insurance income exceptions to subpart F income in Sections 954H and I. Both sets of rules address the ability to avoid current U.S. tax on the foreign earnings of certain foreign subsidiaries of U.S. companies known as controlled foreign corporations, or CFCs. The CFC look-through rule, which was originally enacted in 2006, allows dividends, interest, rents, and royalties to be paid between related CFCs without triggering a current U.S. tax, to the extent the payor CFC earns active foreign business income that would not constitute subpart F income. The active financing and insurance exceptions, which were originally enacted in 1997 and have been extended piecemeal ever since, allows banks, insurance companies, and other financial institutions that are CFCs to earn dividends and interest without incurring a current U.S. tax if the CFCs are sufficiently engaged in active finance activities outside the United States. Both the CFC look-through rule and the active financing and insurance income exceptions had expired for taxable years of foreign corporations beginning after December 31, 2011. Under the recent legislation, the provisions were retroactively extended to taxable years of foreign corporations beginning after December 31, 2011 and before January 1, 2014. Because of the uncertainty surrounding whether those provisions would be extended, some taxpayers elected to change the tax year end of one or more of their CFCs to November 30 to extend the benefit of those provisions for an additional 11 months, or until November 30, 2012. Now that the provisions have been extended an additional 2 years, and because of the added compliance burden associated with a November 30 tax year end for a CFC, taxpayers may be tempted to revoke the tax year end change and return to a December 31 tax year end. However, proposed regulations provide that once the election to change a CFC's tax year end is revoked, a new election cannot be made for 5 years. The November 30 tax year end will remain desirable unless and until the provisions are permanently extended. So revoking the election generally will not be advisable. Indeed, any taxpayers who did not elect a November 30 tax year end for certain CFCs prior to the original December 31, 2011 expiration date may want to consider the election before the new December 31, 2013 expiration date. In addition, to the extent taxpayers may have deferred or postponed certain tax planning due to the uncertainty of whether the provisions would be further extended, those taxpayers now have an additional year to prepare for the expiration of the provisions, should they ever actually be allowed to expire. Thanks for listening.